A historic silver short squeeze has markets in complete chaos as unprecedented conditions strike fear in one of the largest metals markets. Silver's parabolic, now over $51 per ounce for the first time in history. London vaults are drying up, traders are scrambling to borrow metal at insane costs, and a massive short squeeze could send prices rocketing to $100 or more. Here's a long-term time frame look at silver going all the way back to the 1920s. We can see spot silver is now over $51 per ounce, but we have to start from the beginning with the fundamentals. So, silver market is in its fifth consecutive year of a structural supply deficit. This is due to the fact that mining output has remained relatively stagnant, and industrial demand, which makes up about 50% of silver's use, is surging due to things like EVs and solar panels. Now, also, you have a massive surge of demand for silver as an investment. We, of course, know gold has been rocketing due to concerns over fiscal dominance, the debt, the deficit, fiscal concerns. And so you have silver playing a bit of a complementary role there as investment demand is also surging. So inflows into silver ETFs this year are at their highest level since 2020 of inflow into things like SLV. And that is SLV is the ETF that tracks silver, much like GLD here in the US tracks gold. So here we can see the increasing use of silver in various industrial productions, particularly green technology, is expected to be a significant driver of demand. But then you also have, of course, the investment side as well. Remember, with silver, about 50% of silver demand is industrial. Here, for example, we can see automotive demand for silver. Now, to make matters worse, you also have a supply crunch. So, LBMA, or the London Bullion Market Association, their stockpiles of silver could be depleted within 7 months if the current demand trends continue. The investment bank warns that London's free float of silver inventory has reached critically low levels of approximately 155 million ounces. That is only enough to cover 6 weeks of global demand. So here's an article. I will link to all of these articles in the description, but this one in particular I think is really pertinent. There's also a really good Bloomberg article that I would highly recommend on this topic as well. So liquidity in London has completely vanished. Traders now short the physical market are struggling to find the metal, paying steep borrowing costs to maintain positions. There is no liquidity available currently. London and the LBMA is kind of at the center of this. And for more than a century, London has served as a hub for global precious metals, gold and silver mainly, where benchmark prices are set and then vaulted bars circulate amongst a network of banks. Traders are booking transatlantic freight flights to move silver from New York to London, paying rates typically reserved for gold to capitalize on the wide price differential between COMEX, which is the U.S. futures organization, and then the LBMA, which is where the shortage is occurring. So again, they talk about the immediate catalyst as a surge in investment demand for gold and silver as Western debt concerns and currency fears intensify. The tension has been amplified by budget impasse and fears of devaluation. Here, by the way, you can see those stocks at the LBMA of silver. And then, of course, in blue, that is the free float, or what they consider the free float. They say the London Vault network once held a vast cushion of liquidity, but those reserves have been eroding. Bloomberg data indicates that silver inventories have fallen by 1/3 since mid-2021, with the freely tradable supply, that free float, now estimated only 200 million ounces, down from 850 million ounces into 2019. So if you look at the borrowing costs, again, if you're short physical silver and you're getting squeezed, you have to deliver that. Well, here's the annualized 1 month lease rate for silver, 30%. So here we can see the supply crunch. We can see the short squeeze, especially on kind of the paper silver market. Here are prices in London at the daily silver auction. They also do this with gold. Spot premiums have widened to as much as $3 over the New York futures contract. That was what we were looking at in the first slide, while overnight borrowing costs have climbed beyond 100% annualized, levels possibly exceeding even those of 1980, when the Hunt brothers tried to corner the silver market and led to, of course, this epic short squeeze that we saw back in 1980. So, just to show this, this is the supply and demand for silver demand. You can pause the video and take a look. Supply has been stagnating, and demand, again, industrial plays about 50% of that. Industrial demand has been surging. So, it's all the kind of elements of a short squeeze, which is what we are currently seeing. So, here we're looking at silver spot. This is the price of actual physical silver, and then the silver front month futures contract in blue. And this was a wider gap when I had started the video. We can see it's starting to narrow a bit here, but this is referred to as backwardation. This is very, very abnormal. Normally, you have the futures contract trading at a premium to spot, and that was the slide we were looking at here. So here we can see backwardation. This is where, so normally futures prices, again, futures contract represents future delivery. Normally that futures price is going to be higher than the spot price. This is referred to as contango. And the reason for that is you have to cover storage and also interest costs as well. Backwardation is the exact opposite. That is what we can see. The pink line, by the way, represents 0, indicating there is no backwardation, no contango. Well, we can see we are sharply into backwardation. This is very, very abnormal. This chart goes all the way back to the late 1990s. We can see very brief moments of time where maybe it's 23 cents of backwardation, but we have been as high as $2 of backwardation. And what this indicates, again, is that futures are trading below spot price, meaning buyers want the metal and are willing to pay a premium. Now, if we go here to this is the lease rate that we were taking a look at in the Scottsdale Mint article. This is the annualized 1-month lease rate for silver. We can see just absolutely skyrocketing, again, indicating that supply shortage or short squeeze. Here, by the way, is the difference between the New York futures contract at the COMEX versus the London spot silver price, which is at the LBMA. We can see a massive differential. Well, this opens up an arbitrage opportunity where, again, traders can take the silver from the US, from the COMEX, ship it over on a cargo air flight to London and make a spread. So generally, these arbitrage opportunities allow for an equalization where you don't get a dislocation that is permanent between two different differentials because, of course, someone is financially incentivized to balance that out, to arbitrage that gap out. And sure enough, we are starting to see that with some of these cargo air flights that are going from the COMEX here in the US, taking silver bars to London, because again, there's a premium to do so. So you are getting compensated to do so. Here, by the way, is the bid-ask spread in the London silver market. Now, remember, this goes to liquidity. When you have a large bid-ask spread, that indicates deteriorating liquidity. So here's the gold to silver ratio. Now, this is something a lot of people put a lot of faith in. I'm not really sure if there's a ton of signal in it. They say that the historical average for this gold to silver ratio, or put another way, the number of ounces of silver that it takes to equal 1 ounce of gold, they say that that average should be about 80. Well, it is about 80. So I'm not really sure why so many people talk about the gold to silver ratio and why this indicates that silver is going to $500 per ounce. I don't personally see it, but there it is for those that are interested. Here is silver divided by gold, which is the exact opposite. And I think it shows the phenomenon that we're going to look at here a lot better, which is that when silver moves, it can really move fast against gold. So gold, by the way, this morning just hit $4,100 per ounce. So gold is continuing to absolutely skyrocket, as is platinum, by the way, as well. But here in the red line, we are taking silver dividing by gold. So when you see these spikes, silver, of course, being a much smaller market, when you see these spikes, what is indicating is that silver is appreciating far and above the price of gold. And we can see it during various precious metals bull markets like we saw here, kind of the mid 2000s, and we are starting to see now. Now, as you can tell, when a silver bull market or precious metals bull market really gets going, silver can greatly outperform gold. And the reason for that, of course, is again, there's that 50% industrial demand, which gold does not really have. Most gold demand is monetary based. Silver has that half industrial demand, which, by the way, is surging due to green energy technologies and EVs. So you have the demand side getting squeezed, of course, and we know that supply from the prior chart, we know supply has been relatively stagnating. Well, not only that, but silver is a much smaller market, only about $2, 3, 4 trillion in market cap, depending on how you measure it. Well, gold is much closer to, say, 25 trillion. So it takes a lot less capital to really move silver. And that is why when you see these bull markets, silver can greatly outperform gold because it is a much smaller market. Now, this is the Bloomberg article that I would highly recommend reading. It's should have no paywall since I have a subscription, so you should be able to read it. Leave a comment if it's not working, but hopefully that works. And again, we'll continue to watch the spot over futures price. This backwardation, again, you can see that there are periods of time, brief periods of time, where you get a little bit of backwardation, maybe 20, 30 cents. But to have $1.60, $1.70, $1.80, which is what it was earlier this morning, this is kind of a red alert. Even some of the mainstream financial outlets like Bloomberg and CNBC are kind of hair on fire. This is not good. And so, of course, this can trickle into gold. This can trickle into platinum, all of which are physical metals that have some degree of investment demand due to all of the issues that we've been covering on this channel when it comes to de-dollarization, the debt, the deficit, all those sorts of things. So you have real physical commodities like silver, like gold, like platinum, that historically have not really done that well. Well, when they're relatively small markets and when you have a surge of demand, and of course, increasing industrial demand with silver, but when you have a surge of this investment demand, it can cause dislocations, which is exactly what we were seeing in the silver market. Again, not just industrial demand, which we know is surging due to EV technologies, but also due to, of course, monetary demand or that safe haven, neutral reserve asset sort of demand. By the way, the first central bank announced silver purchases, physical silver purchases. That was the central bank of Russia. They announced, I think, 500 million ounces of silver purchases. So it's becoming literally a monetary asset after hundreds of years of kind of just fading away from being that monetary asset. You are seeing a return to using silver as a monetary asset, at least in the case of Russia. Physical commodities are actually mattering once again. Paper contracts, derivatives, all of these things are showing that they are not really nearly as valuable and they are subject to these dislocations. People want physical metals, physical commodities, whether it be rare earths, like we just saw. There is a shift away from this kind of digital and hyper financialized paper contract derivative complex on every single thing. There's a shift away from that back into, no, it helps to actually hold the physical thing. So anyways, hopefully that was helpful, and I'll catch you in the next one.